How much should you pay yourself from your S-Corp so the IRS nods and you still keep cash? Get this wrong, and the savings can vanish. We will make it simple. Today, we decode reasonable salary, the rule that turns owners into employees and keeps payroll taxes fair without tipping extra to the IRS. You will know your number by the end. Stick to the end for a simple number recipe and a worksheet-style checklist you can use to back up your pay if anyone asks. No spreadsheets needed. Reasonable salary means you pay yourself a wage for the work you actually do, like any employee doing the same job in your market. Think market, not magic. Think of your S-Corp like a pizza shop. Salary pays the cook for making pies. Distributions pay the owner after the pies sell. The IRS rule exists because S-Corps avoid self-employment tax on distributions, but not on wages. No wage at all is not allowed. That is the trade. So your pay has two buckets: W-2 salary that runs through payroll, and owner draws called distributions that do not hit payroll tax. Both buckets matter at tax time. Reasonable salary is not a fixed percent. It is a defendable dollar amount based on your role, time, skill, and market rates. You must be able to defend it. If you wear many hats, imagine splitting yourself into roles, price each role at a going rate, and blend them back into one paycheck. That blended wage is your reasonable pay. This applies if you are an S-Corp owner who works in the business and takes money out. That makes you a shareholder employee. If you take draws, you likely need wages. It matters most when profit is healthy, because more goes out as distributions. More draws mean more eyes on whether salary was real. Auditors look for mismatches. If you do not work in the business like a passive investor, salary is not required. You cannot pay a wage for no work. No work, no wage. If the company is losing money, you still owe a reasonable wage for the services you performed, but you might set it toward the low end. Cash flow still matters for timing checks. Here's a simple framework. List your roles, find market pay for each, estimate your time split, then math it into one annual salary. Then sanity check the result. Role examples: sales lead, project doer, admin, marketing, CEO. Use job sites, BLS data, or local recruiters to grab pay ranges. Write the source next to each rate. Pick the middle of the range for each role given your skill and city. Senior work gets more. Trainee tasks get less. Estimate time. Maybe you spend 50% on client work, 30% on sales, and 20% on admin and CEO tasks. Your mix is unique. Now do the math. If client work pays $90K, sales $70K, admin $45K, and CEO $80K, the time-weighted blend might land near $72K. Use round numbers, not pennies. Pay that through payroll as W-2 wages. Withhold income tax if you want, and you must withhold Social Security and Medicare. Use payroll software or service. Then you can take additional draws as distributions. Those are not hit with payroll taxes, but they still show on your K-1 and return. Your books should show both clearly. Example math. Company profit before your salary is $180K. You set salary at $72K. That leaves $108K potential distributions if cash allows. Payroll taxes hit the $72K wage, saving you self-employment tax on the $108K draw. That is why the salary decision really matters. Save, but do not get greedy. Mistake 1. Paying zero wage. The IRS can reclassify your draws as wages, assess back payroll tax, penalties, and interest. That can get very pricey fast. Mistake 2. Picking a number based on your bills. Reasonable salary is about market value of your work, not your rent or groceries. Budget at home, price at work. Mistake 3. The blanket 50-50 rule. There is no magic percent. Some owners should pay 90% salary, others 40% based on roles. Mistake 4. Forgetting to document. If you cannot show your sources in math, you lose the argument before it starts. Paper beats memory every time. Mistake 5. Paying once a year. Payroll must actually run, with pay dates, stubs, and deposits. Aim at least quarterly, monthly is better. Mistake 6. Ignoring benefits. Health insurance for a 2% owner goes on the W-2, and retirement matches count toward total pay value. Total comp is what matters. Pro tip. Use a role mix worksheet. Write roles down the left, rates on top, time down the middle, and watch a defendable number appear. It turns fuzzy into firm. Pull 3 sources for each rate. For example, a job site, a BLS table, and a recruiter email. Keep screenshots in a folder named Proof. Adjust for location and benefits. If you work remote from a low-cost city, trim a bit. If you include a 401k match, add a bit. Set a band, not a dot. Pick a target like 68K to 76K. Stay inside that range unless your role or profit changes a lot. Time your payroll. Pay a steady amount each month, then add a year-end true-up if needed so your W-2 lands in the band. Avoid giant December catch-up checks. Document with a one-page memo. Title it Salary Plan, list sources, your math, and your final number. Sign and date it. Bonus saver. Use an accountable plan to reimburse business costs tax-free. That keeps your wage clean and reduces payroll outlay. Use a simple plan template. Action today. Write down your roles, time split, and 3 pay sources for each. You can finish the research in under 1 hour. Start with your 2 biggest roles. Pick your salary band and set up payroll. If you already run payroll, schedule equal checks for the rest of the year. Consistent beats perfect. Create a folder named Salary Plan. Drop your memo and screenshots inside. Share it with your tax pro or future you. Calendar a quick review for next year. If profit, roles, or location change, update the worksheet and adjust the salary. Set a date you will keep. Subscribe for daily plain English tax tips. Next up, S-Corp health insurance on the W-2 and how to not miss the deduction. Taxes explained.